Hello, very good morning to all and welcome to today's Daily Dose again. I'm Kelvin here. Very good morning. Today will be the Wednesday, the 14th of August 2024. So before we start our Daily Dose, as usual, let's have a quick look at this disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, before we jump straight into today's short-term intraday technical outlook on the major cross-asset classes, let's have a recap what has taken shape yesterday in terms of the performance of these respective major cross-asset classes and its related news flow and economic data releases. Then after that, I'll follow with the current, medium-term, and intermarket dynamics that is taking shape in the marketplace right now. So let's start with yesterday's news economic data release first. All right, so let me go through the economic calendar. So what you could see over here is that yesterday we do have a key, not really that key, I would say that relatively key US economic data release, which was the PPI data. So we know that PPI data is considered as factory gate data. More or less, they consider as cost of production or cost of goods, which potentially could have an impact on today's much more important data release from the US side of the story, which is the consumer inflation data. So yesterday, core PPI data, the core PPI, that means excluding those much more volatile related cost of products, like related to energy and food, managed to actually inch down lower than expected. So market is actually pricing in 2.7% year on year. All right, for July, but actual figure came in 3 basis point lower or 0.3 percentage point lower at 2.4%, and also much lower than 3% that was printed in the previous month of June. So that also more or less have an indirect impact of consumer inflation trend. That means more likely pointing towards the downside for today's data, which cemented the first interest rate cut by the US Federal Reserve for the month of September. More or less, it's already been priced into the market. So if you look at the CME Fed Watch 2 very quickly, so this shouldn't be a big surprise for you guys who actually followed my daily dose on a frequent basis. So we could actually use this particular website, which is slightly delayed by 1-2 hours based on the current Fed funds futures pricing, and from there they calculate what is the current probability as being priced by the Fed funds futures market on the interest rate cut, hike or hold on the next upcoming US Federal Reserve meeting. So very quickly we go to the probability. So this gives us an aggregate picture over here. So what we could see over here is that currently the Fed funds rate is at 5.25% to 5.5%. So right now market is now sandwiched up between either a 25 basis point cut or a 50 basis point cut, a much more larger cut on the 18th of September meeting. So this probability more or less hasn't really changed that much compared to the last 1 to 2 weeks of data. So why 50 basis point? Because there is still a risk of a so-called potential hard landing scenario that could take shape in the US economy, or that could be playing out right now. And later I'll share with you what other key data to look out for to actually have that market participants will be playing a close watch of other than today's US CPI data. All right, so overall net we see a very strong positive reaction from the major US stock benchmark stock index. So across the board, all the 4 major stock indices all ended in the green with positive gain, led by the last 3 to 4 weeks worst hit big cap technology stocks, which is the heavily weighted in the NZD 100, that is up 2.5%. But bear in mind over here is that for those who followed my short-term intraday technical outlook, whatever rally that we see so far is more as a higher probability of a mean reversion rebound. And yesterday, NASDAQ 100 hit our resistance inflection zone of 9,100 level. Later I'll touch more about that. All right, so 2.5% for Nasdaq 100, the SPX 1.7%, the Dow Jones almost 1%, and the Russell 1.61%. Right, so across the board intraday gain. So that shouldn't be a surprise. Why? Because in my intraday technical outlook, we have been expecting this potential mean reversion rebound after that dramatic last Monday sell-off that hit a capitulation point. All right, so it's really moved within our trajectory. And what we could see over here is that for a dollar perspective, the market continues to be rather have a mixed bag faction. So what we could see over here is that yesterday the dollar actually weakened against the euro and the sterling, but continues to remain rather firm against the dollar yen. All right, and right now what we could see over here is that there's some mixed whipsaw going on in the marketplace right now. The dollar right now is in fact we call it weakening against the Japanese yen and leading down to the Swiss franc. So later I'll share because of this particular news flow over here up from Japan. Let me share with you very quickly. So the current Japanese Prime Minister over here, where is it? Yeah. Okay, so the current prime minister Kishida said that he will actually step down. So he will actually not actually, because right now there could be a potential snap election this year in Japan, and he's coming from the LDP party. So in order because this coming September there will be a LDP party vote, right? So it will be a leadership vote. So he decided to actually step down ahead of this leadership vote. All right, so causing a bit of political risk premium that is being we call it seen in Japan right now, that causing the yen to actually, the Japanese yen to actually strengthen because of this risk premium impact. As you know that the yen is considered as a safe haven currency. So what we could see over here is that the Japanese yen actually strengthened against the dollar, or the dollar weakened against the yen, then also causing another safe haven currency, which is the Swiss franc, to actually strengthen as well. That means the dollar weakening against the Swiss franc. And what's interesting over here is that we start to see the dollar spiking up against the Kiwi over here, very obviously. Why? Because like I mentioned yesterday, there could be a potential dovish RBNZ, which indeed it take place. So what we could see over here is that the RBNZ, the New Zealand Central Bank actually cut interest rate unexpected by 25 basis point. So that also causes our Aussie Kiwi, which I shared with you all, especially yesterday, to actually rally as well, right? Exactly at my pivotal support that we highlighted, 1.0890, 1.0840. Later I'll touch more about that in this technical, I covered the technical chart segment of the daily dose. All right, so these are the key, we call it events that to shape in terms of news flow, central bank, the RBNZ central bank meeting, as well as the economic data release out from US session. Okay, so now the next step I want to share with you all is more on the fundamental and the intermarket dynamics that could actually see a much more impact the longer term perspective. That means to couple from a multi-week perspective. All right, so one particular juncture over here is, we know that if we were to look at the current situation of what has taken shape yesterday in terms of the US Treasury yield, US Treasury yield. Okay, where is it? Yeah, this is the chart. Okay, pardon me, a bit of management. Okay, yes, this is the chart. All right, so okay, this is the US 2-year Treasury yield moving very in line with the US Federal Reserve monetary policy. So if you recall over here is that previously, since the breakdown on 26th of July, where we start to see a huge plunge in the 2-year Treasury yield, so that actually has a tremendous price-in impact, indicating that the US Federal Reserve is likely to be getting more and more dovish, and also there's a possibility of a much more larger 50 basis point cut in the September meeting. So that is kind of being priced into the current CME Fed Watch 2 right now based on the Fed Funds futures market, because currently right now the Fed Funds rate is 5.25% to 5.5%. A 25 basis point cut takes down to 5% to 5.25%. 50 basis point cut take down to 4.75% to 5%. So almost the same odds as except the 50 basis point cut has a slightly higher odds at 52.5%, and that is being also dictated by this rather steep down move of this US Treasury yield curve. And yesterday it started to shift that bearish reaction of its intermediate resistance at 4.12%. So that also corresponds to the downward sloping line. And bear in mind that if you recall that this steep slide in the US 2-year Treasury yield, yes, it may be good for the US economy. Why? Because lower cost of funding, short-term lower cost of funding coming to play, and eventually we also start to see the 10-year Treasury yield also similarly inching downwards as well. Okay, but it hasn't really broke below the last year December medium-term swing low yet at 3.78%, whereas the 2-year has already broken right over here and now turns into a pullback resistance where market has a bearish reaction of it in the last 2 sessions. So indicating to us market is now pricing in a rather much more dovish US Federal Reserve. Good for the US economy, but not good for the risk asset. Why? Because it's indicating that perhaps the Fed is a bit late in cutting its interest rate in light of a US recession that may be already in motion in terms of probability, higher odds right now. All right. So if the US 2-year Treasury is going to shape a much more drastic decline going forward in the next 2 sessions, especially ahead of in these 2 days with the US CPI data that is out today, and tomorrow you see retail sales. Retail sales figure will have an indication of whether the US is in a possible recession yet or not. Why? Because retail sales is part of the services activity in US, and services activity in US contribute close to 3/4 of US economic growth in the last 5 or 10 years or so. It's also something very important to be mindful of. So if the 2-year Treasury is going to plunge downwards by the similar magnitude that we see last week, it may trigger off another mini risk-off event in the stock market, especially given that like I shared earlier, the NZD 100 rallied close to our resistance level already, all right, which is the 19,100 that I've been highlighting in my daily dose of market insights since last week. And also another intermarket, this will be the fundamental. Now, let me share with you another intermarket correlation is looking into account of the volatility. Okay, so what I did over here is, this will be VIX, right? We all know that this is a VIX. So this is the tremendous push up in the VIX. We call it the Varmogeddon 2.0, caused by Carmageddon, the short gamma scenario, a push up. Then thereafter, it retraced downwards, right? And now it go back down towards the Bollinger Band 20-day moving average. All right, it's now coming downwards. But if you look at the second derivative of the VIX, that means the rate of change of the VIX, which is the VIX, volatility of VIX. So it's a rate of, put it away, is that VIX is option, right, on the S&P 500. VVIX is a kind of a option on the VIX itself, right? So it's a volatility of the VIX. So it's a second, no, I'll say that it's a third order derivative right now. That means, as we know that derivative always have a leading element to it because it's a measurement of a rate of change, think of it. So this VVIX over here, yes, it came down as well, but it came down at a slower pace and it's still holding above the 20-day moving average over here. And the next step, what I did over here is that I plotted the ratio of the VVIX versus the VIX. And you realize that the VVIX divided by the VIX is now inching upwards, all right, coming very close to a critical level of 6.7. And this 6.7 level over here previously lead to that sell-off on the SPX. Okay, this is the SPX over here. Okay, it lead to the sell-off. Previously, once it hit the 6.6, there was also a sell-off as a mini decline as well over here. And previously, somewhere around this level, during the March 2024 to 18 April, the spring decline. This year, the decline of spring season decline on the SPX 500. And what's interesting over here is that the S&P 500 now has already come also close to a resistance level, which is this gap down over here. Okay, at the 5,440 level. And if I were to pull in the moving average, okay, so let me add the indicator. It's very close to the 50-day moving average as well. Okay, put in the moving average for you guys to see. Give me a minute. Yeah, simple moving average. Okay, let it open. Okay, let me do a bit of close. This is 50. Okay, let me fix it to a daily chart time frame. Okay, 1 day. Then let me change the color. This. Okay. Notice that it also at the 50-day moving average, I think, as a resistance. So now with the S&P at the resistance, with the VVIX divided by VIX ratio coming close to a critical high at 6.77 that previously saw that led to prior decline on the SPX 100. And right now, with the 2-year Treasury yield shaping that bearish reaction of a former medium-term support now turns into a pullback resistance, there's a big risk that we may hit a tipping point on the rally that was since start of last Monday on the major US stock indices, where potentially at least there could be a form of retracement or a pullback first in this coming few days in the shorter term. Then thereafter, if the market continues to come down over here, then this is where potentially we may start to see another round of we call it medium term or multi-week potential decline in the global stock indices. That means we talk about going back to a kind of a risk off scenario again. All right, so yes, this is the key fundamental and intermarket dynamics that is taking shape right now that I'd like to share with you all, for you all to actually to be aware of that market part that could be taking shape in the marketplace right now. So with that, let us now jump straight into the intraday technical outlook. All right, starting with the FX market. All right, so over here, let me actually expand my screen so that you guys could see much clearer on the key levels. Okay, great. So let us start with the FX market first. Over here, starting with the euro dollar. So if we call that the euro dollar, yesterday we were neutral between 1.0950 and 1.0895. So very clearly we start to see a bullish breakout from the upper neutrality limit 1.095, and this 1.095 is so pretty much crucial. Why? Because if we go to the daily chart again, a quick recap. Previously on Monday itself, it can't have a daily close above this dotted gray line here. So what is this dotted gray line? This dotted gray line is in fact a medium, I would say it's a major symmetrical triangle range resistance that I drew from the high of 19th of July. So almost a year already, price action has been kept below this symmetrical triangle range resistance or the upper limit. And yesterday it managed to finally have a clear bullish breakout above it with a daily close above 1.095. So with that, we got to respect the price action, which is has a much more bullish in nature at this juncture. So on a intraday basis for today, we will flip to a short-term intraday bullish bias on the euro dollar. But bear in mind that right now the RSI has already hit a overbought level and now trying to exit from the overbought level at this juncture while we are speaking. During the Asia session, there could be a form of a minor pullback taking shape. Right, a minor pullback taking shape. So first support level to watch in this minor pullback, if I do the Fibo retracement over here all the way up, potentially could be around the 38.2% Fibo retracement. Okay, over here. They also correspond to this minor congestion area over here at 1.096 level. But I don't want to put it so tight. I will put it to 1.095, which is very important as well, because why 1.095 is now the pullback support level of this dotted gray line, which is the former major symmetrical range resistance, now turns into a pullback support. And if we do the Fibo retracement of the yesterday's short rally up, it also corresponds to the golden ratio of 61.8%. All right. So as long as this minor pullback potentially that it could take shape right now, why? Because of a overbought region that's being flashed out by the hourly RSI, and now the RSI is attempting to exit from its overbought region. So as long as this minor pullback didn't surpass below 1.0950, we will flip to a short-term intraday bullish bias on the euro dollar above 1.10 figure level, exposes the next near-term resistance level at 1.1025, followed by 1.1060, 1.1080 next. Only an hourly close below 1.0950 will invalidate today's intraday bullish bias to see it floating down to expose the next near-term support level at 1.0895, which corresponds to the 20-day moving average thing as a support level as well, followed by 1.0870 next is if 1.0895 is taken out on the downside. So the next zone will be 1.0870 slash 1.0840, with so confluence with the 200-day moving average, I think as a similar support level as well. So that's for the euro dollar. So for the sterling dollar, we have a bullish bias in the last two sessions. Price action almost came close, already hit the second resistance at 1.2890 level, all right, and clear above the 20-day moving average. Similar as well, the hourly RSI now has started to exit from its overbought level, so there could be a risk of a minor pullback taking shape in first towards 1.2830 level. So as long as this minor pullback didn't surpass below our Titan key short-term pivotal support that we have for today, 1.2780, which also corresponds to yesterday's US session low, and as well as the 50-day moving average, I think as a resistance support level right now as well. So as long as this minor pullback didn't surpass 1.2780 level, we will still maintain that short-term intraday bullish bias on the sterling dollar above 1.2890, exposes the next near-term resistance at 1.2940, which is the congestion area of 22nd of July and 16th of July this year. However, if the price starts to pull back and shape a hourly close below 1.2780, it will invalidate today's bullish bias on the sterling dollar to see a much more deeper corrective intraday drop to expose the next near-term support level at 1.2730. A breakdown below 1.2730, retest the 200-day moving average. We're so very close to the 8th of August minus swing low, coming to a support level at 1.2660 level. Right, so that's for the sterling dollar. So now with that, let us focus our attention now to the dollar major against the Asia Pacific currency over here. So starting with the Aussie dollar. So the Aussie dollar, what we could see over here is that price action push up, a bit of whipsaw at the 66.30 short-term pivotal resistance that we highlighted yesterday. Very clearly, the reaction came off the 50-day moving average. So like I mentioned earlier on, today that could be the sign of a minor, we call it a retracement, or a minor risk of event or impact on the major US stock indices. Why? Because of the risk factor that I shared with you earlier on. The Aussie dollar is also considered as a proxy of risk on, risk off as well, especially in the last few days, given that we know that this dramatic push down was due to that risk off event, and this rebound that's seen in the Aussie dollar was due to that mean reversion rebound, or the rebound that's seen on the global stock indices. And with the risk of the global stock indices shaping that mini risk off or retracement that I highlighted earlier on the intermarket dynamic section earlier on, we'll still maintain that Aussie dollar bearish bias, giving a bit of whipsaw at today's session high at 66.40. So a bit of excess at 66.40. So as long as 66.40 short-term pivotal resistance holds, we will still maintain that short-term intraday bearish bias on the Australia dollar. First near-term support level to watch on the intraday, there's two. One will be at 66.05 over here, which is very close to the 200-day moving average that was surpassed in yesterday US session, in line with the push-up of the major US stock indices. A breakdown below it exposes this Monday swing low, which is this week low at 65.65. All right, these are the two key level. But however, if it starts to break down much lower at 65, 65, it will expose 65.14 next, which is the minor swing low of 7th of August and 8th of August. And if you do the Fibo retracement of the ongoing minor rebound, that also correspond to the 38.2% Fibo retracement. Only a push up with an hourly close above 640 will invalidate today's intraday bearish bias on Aussie dollar to see a squeeze up to expose the next near-term resistance zone of 685/67 figure level, minor congestion area of 19th of July and 22nd of July, and also the 76.4% Fibo retracement of that previous drop from the high of 11th of July all the way down to last Monday, 5th August low. Okay, so that's for the Aussie dollar. So very quickly, I touch on, since we're talking about the Aussie dollar, let's quickly go to the Aussie Kiwi pair. So this I highlighted yesterday to take up to actually in light of the potential RBNZ dovish stance, which indeed it play out as expected. So still no change. What we could see over here is that the Aussie Kiwi pair over here, this way we can actually capitalize on the relative player, okay, between we took out the dollar from it. So this Aussie Kiwi here continues to trade within this medium-term ascending channel configuration in dotted turquoise green over here since the low of 22nd of February. So right now is attempting to test the first resistance that we highlighted yesterday at 1.1030. So if this level breaks up, at least we could see a retest of 16th of July and 26th of July medium-term swing high area at 1.1165/1190 next. All right, and also the medium term momentum is rather positive or bullish, given that the daily RSI starts to inch up, shaping a higher low and hitting above the 50 level mark as well, and has yet more room to go before hitting the overbought level. All right, so that's for the Aussie Kiwi. All right, now with that, let us now focus back to the dollar yen from here. So I could see the dollar yen, this is the dollar yen. On the daily time frame chart of the dollar yen, what we could see is that the last few days of price action can't actually starts to shape that so-called very small candle, all right, body candle over here. So indicating not much of a conviction for it to actually push up much higher to retest this level here, okay, around the 150 level. So that was our resistance that we highlighted yesterday, which is so the pullback line of this former major ascending channel support level died through from the low of 16th of January 2023, now turns into a pullback resistance and also correspond to the downward sloping 20-day moving average as well, all converging at around the 150 level mark. Okay, so with this daily candle, this success, I think what we have over here, 1, 1, 2, 3, 3 succession day of small little body daily candle, indicating the lack of conviction for it to push up higher to that 150 level. So on a short-term intraday basis, we will actually look at it over here. Okay, whoops, where is it? Okay, on the hourly chart of the dollar yen, you realize that it can't actually go past the first resistance that we highlighted yesterday, which is 14850. All right, so with that, right, I will use this 14850 as my short-term pivotal resistance for today, given the fact that the last 3 days of price action as seen on the daily chart is rather lackluster, as I explained earlier. So I will flip to a short-term intraday bearish bias on the dollar yen for today using 14850 short-term pivotal resistance. First support level to watch in the near term on the intraday basis will be 14580. A breakdown below 14580 exposes 14420 next. All right, so these are the two intraday levels to watch. All right, only the price break up above 14850 today, that means a breakout of hourly close above 14850, then potentially we may see the continuation of this mean reversion rebound to retest that 20-day moving average and also the 200-day moving average, I think as a resistance zone at this 151 figure slash 151.70 next. All right, so that's for the dollar yen, and also sum up the intraday technical outlook on the major FX pairs. Okay, so now let us focus now our attention back to the major stock indices, starting with the Hong Kong 33 or the Asia Pacific stock index first. For the Hong Kong 33, i.e. the Hang Seng Index, no change, still can't break above the 17,270 short-term pivotal resistance that we have since the start of this week. So since this level is not taken out on the upside and price action now reintegrate back below the 20-day and the 200-day moving average, and also with the hourly RSI now, if we draw the kind of a parallel trend line support, taking into account of this low over here that correspond to the last Monday low, it has clearly broken down below this parallel trend line support level. So indicating also a lack of upside momentum inherent right now in the Hong Kong 33, the Hang Seng Index. So still no change using 17,270 short-term pivotal resistance, maintain that short-term intra-day bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. The near-term support level to watch remains the same on the intraday basis, 16,880, followed by 16,720 next. Only a push up if an hourly close above 17,270, then will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound scenario to expose the next near-term resistance zone of 17,410 slash 17,517. Above it, potentially sees a retest at 17,750, which also correspond to the 50-day moving average, I think very closely at a similar resistance level as well. So that's for the Hong Kong 33. Moving on will be the Nikkei 225, i.e. the Japan 225. Still recall the Japan 225, we have a bullish bias since last week. Price action already hit the resistance level, the first resistance level at 36,885, very close to it. And right now there is, if you look at the hourly RSI, there's actually a bearish divergence as well. All right, a slightly lower high, then react off the lower high back down towards this level here. All right, the middle part of the RSI range. So given the fact that it's coming very close to our resistance level, also mathematically it's also the 200-day and the 20-day moving average acting as a resistance as well, and as well as this descending trend line that I drew from the high of 11th of July that is coming very close to this similar level. So I'll use the upper limit at 37,480, which is the former minor swing low of 25th of July, where this level break kick-started that dramatic intraday sell-off. So psychologically, it could have an impact as well. So using 37,480 as my short-term pivotal resistance for today on the Japan 225, flip to a short-term intraday bearish bias. First support level to watch on the intraday basis, 35,740. A breakdown below it exposes the minor swing low area of last Friday at 34,910 slash 34,645. Only a push up with an hourly close above 37,480 will invalidate today's intraday bearish bias on the Japan 225 to see the continuation of the rally to expose the next near-term resistance level, 38,430, followed by 39,270 next. All right, so that's for the Japan 225. Up next will be the German DAX or the German 30, one of the major European benchmark stock indices. So very similar as well, the German 30 rallied in our expectation and come close to the resistance level that we actually expressed yesterday, 17,960. So this 17,960 also correspond to the key former minor swing low of 14th of June. All right, and if we will do the Fibo retracement of this dramatic fall from 1st of August all the way up to last Monday low, okay, it also correspond to the golden ratio as well, very closely, 61.8%. All right, so that being said over here, given that there could be a synchronized mean kind of a minor potential decline in the major stock indices, we will flip to a short-term bearish bias on the German 30, i.e. the German DAX for today, using this key short-term pivotal resistance as my level, 17,960. First support level to watch on the intraday basis will be 17,645, followed by 17,530 next, which correspond to the 200-day moving average acting as a support level. However, if price action managed to have a breakout with an hourly close above 17,960, then today's intraday bearish bias or the German 30 will be invalidated to see the continuation of the rebound to retest the next near-term resistance level at 18,140, followed by 18,270, which correspond to the 50-day moving average acting as a resistance level as well. All right, so with that, let us now touch our shift our focus to the major US stock indexes, starting with the US Wall Street 30, i.e. the Dow Jones Industrial Average. So the Dow Jones Industrial Average, similar as well, also come close, almost hit our resistance level, which is the upper limit of this minor ascending channel here. So with that, we'll be flipping to a short-term intraday bearish bias on the US Wall Street 30 using 39,845 as my short-term pivotal resistance level. Will also correspond to the former minor swing low area of 25th of June and 26th of June. So intraday near-term support level to watch on the intraday basis will be these two levels, 39,575, followed by 39,235, which is currently this week low level. All right. However, if price action have a hourly breakout with a close up above the 39,845 level, then today the intraday bearish bias on the US Wall Street 30 will be invalidated to see the continuation of the red of this push up to expose the next near-term resistance level at 40,110, followed by 40,380 next. All right, so what's up for the NZD 100? So the NZD 100, yes, it continued to rally, shaped a very steep push up, hitting the resistance zone of 19,100/19,230, which saw a Fibo extension level, and so the upper limit graphically of this minor ascending channel that I drew from the low of 5th of August. So with that, using 19,230 as my short-term pivotal resistance for today, flip to a short-term intraday bearish bias on the NZD 100. Near-term resistance level to watch on the intraday basis, there will be 18,680. Below it exposes this week current intra-week low at 18,435/18,310, which is the lower limit of this minor ascending channel, I think as a support level next. Okay, however, if price action push up and have an hourly close above 19,230, then this intraday bearish bias will be invalidated on the NZD 100 to see the continuation of the rally to expose the next near-term resistance level at 19,600, which is the minor swing high area of 1st of August, and came in quite close with the 50-day moving average acting as a resistance as well. Above 19,600 exposes 19,900 next, which is the minor swing high of 23rd of July, and also correspond to the two-time Fibo extension of the rally that I drew from the low of 5th of August over here. All right, so that sum up the intraday technical outlook on the major stock indices. So with that, let us now focus our attention to the commodities market, starting with gold XAU/USD. So still recall for gold XAU/USD, yesterday we flipped back to a bearish bias within a range configuration that is still playing out in gold from a very short-term perspective. Since the all-time high of 17th of July, it continues to be a sandwich between this potential ongoing minor so-called symmetrical triangle range resistance that potentially could be another leg down in terms of the Elliott wave, because Elliott wave tends to look at a 5-wave movement for a symmetrical triangle range resistance to play out. So this move here from 17th of July all the way down to 26th of July, it comes at wave A. This is wave rebound, wave B, wave C, wave D, then thereafter the end of the wave E. Then after the wave E ended, potentially we may kickstart another round of a impulsive up move to actually see a much more meaningful bullish breakout of this symmetrical triangle range resistance. So until that, the timing is not that right yet in terms of a Elliott wave perspective. So with that, still no change. The price action on the gold XAU/USD also transfers to a negative, we call it observation on the hourly RSI as well. So you look at the hourly RSI, if you draw a parallel support level, this parallel support level has clearly been taken out right now as we are speaking, so indicating the lack of upside momentum on gold. So in support with that Elliott wave count of that potential wave E that is playing out right now on the minor symmetrical triangle range configuration that's in play. So no change, using 2,483 as my short-term pivotal resistance as is it 2 days ago, still maintain that short-term intraday bearish bias of gold XAU/USD within this minor symmetrical triangle range configuration. First support level to watch 200457, a breakdown below it exposes 20435 and potentially 200415 next, which is so the middle part of this symmetrical triangle range configuration. And currently right now the 20-day moving average that is acting as a support level similarly at 200415. Only a breakout with an hourly close above 2483 will invalidate the bearish bias that we have for gold XAU/USD to see a start of an impulsive up move to expose the next near-term resistance in first step at 200510 next. Okay, so that's for gold XAU/USD. So lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we do have a neutrality bias between 80,030 to 78,460. So price action hit the lower limit of that range at 78,446 before staging that bounce. And very interestingly, how it bounced right at also the mathematical indicator, the moving average of 200 and 20-day moving average acting as a support. So there's actually 3 different elements where it actually managed to bounce off. So with that, we'll flip back to a short-term intraday bullish bias on the West Texas oil using 78.46 short-term pivotal support level. First resistance level to watch on an intraday basis will be 80.30. Above 80.30 exposes 81.20. So what's 81.20 is actually the minor trendline descending resistance that is in place since 5th of July this year. Only the price breakdown with an hourly close below 78.46 will invalidate today's intraday bullish bias to see a much more deeper corrective intraday pullback for West Texas oil to expose the next near-term support level at 77.35 followed by 76.30 next. All right, so that sums up the intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar. What are the key things to look out for today? So before the release of the US CPI data, so at 2 p.m. We have the release of the UK CPI data with the UK inflation rate. So market expectation is another low level of inflation rate, core inflation rate, where in UK is expected to further decelerate to 3.4% year on year to below 3.5% year on year that was printed in the previous month of June. So that will be out at 2 p.m. Singapore time. And thereafter, we'll start to see some European or Eurozone key economic data, which is this Q2. Okay, so it's not a monthly one, it's a Q2 labor market data, they call it employment change, a preliminary data out at 5 p.m. Singapore time. And at the same time, you have the industrial production for the month of June. GDP growth rate, not that important because this is the second estimate, all right? So they already released the first estimate already last, I think, 2 or 3 weeks ago. So 5 p.m. we have industrial production for Eurozone. Then thereafter will be the all-important 8:30 p.m. core inflation rate. So the core inflation rate market expecting another very, very low ball number, 3.2% year on year, all right? Inching much lower from 3.3% year on year that was printed in the month of June. All right, so if it comes in within expectation, so if you look at the core inflation rate over here, more or less it could cement the start of the interest rate cut cycle in US in the September FOMC meeting. So if you look at currently the trend, okay, so market is looking at it's going to decelerate. So the 5-year trend, if you look at 3.3 in June, so market not expecting it to hit 3.2. So if coming in 3.2, that should be the lowest level in the last 3 years or so, okay, since April 2021 over here. Okay, so then thereafter, we'll rather have a rather quiet session. Okay, one more for much more related to West Texas crude oil will be the weekly EIA crude oil stockpile weekly change for the week ending 9th of August. So that will be out at 10:30 p.m. Singapore time. Then thereafter, today's there will be no US Federal Reserve official speaking. And one more key data to watch on Thursday, we'll cover that in tomorrow daily dose, but the highlight to you will be much more related to the US one, will be this retail sales. All right, so retail sales is very important. Why? Because it will give us a gauge whether consumer confidence or spending is still resilient in the US economy or not. So we'll touch more about that. So they'll be out at 8:30 p.m. Singapore time for tomorrow. And also much more related to the China data or the Hang Seng Index or the Hong Kong 33 will be a bunch of key China economic data that could actually detect more on consumer confidence and industrial production as well as the housing market, right? So all this will be out at 9:30 a.m. Singapore time tomorrow, early morning, housing price data industrial production, retail sales up half an hour later at 10 a.m. Singapore time. All right. So with that, that sum up today's daily dose of market insights. Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.